Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by Betashares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, Betashares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with Betashares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Hello and welcome to this episode of the Australian Finance Podcast, where we're talking superannuation. Gemma Mitchell, how are you going?
I'm going great. Excited to talk about super like usual.
Yeah, we're going to be talking about super in about 20 to 25 minutes. We're not going to be able to cover everything. Super's pretty vast when it comes to what you can do with it, why it's important and those types of things. So there's plenty of resources available in your podcast player, in the show notes, as for all of the episodes in the summer series. Gemma, first of all, let's imagine someone's just landed on Earth and they've said, super, what's that?
Yes. Well, so my goal for this episode is for people just to know that it's not boring and get a little bit excited about it so they're keen to learn more. Okay. But what superannuation is it's our retirement savings. So it's a structure set up for us to save for retirement. So it's as if the government knows that we wouldn't prioritise saving for future over today, right? Pretty common. I don't think a lot of us would have the discipline to put money away for future us. It's a compulsory savings for retirement that was set up in the early 90s, and it is not as boring as it sounds.
I like that you use the word structure.
Yes.
Because people think super's like this foreign thing.
Yes.
They hear super fund and they're like, oh, I'm with Australian Super. I'm with Host Plus.
Yes.
Not realising that what is actually in it is what really counts.
Yeah, that's exactly right. There's huge misconceptions. So the amount of times that I have heard people say, oh, I hate super, it's too risky. So-and-so I know at a barbecue lost all their money in super. I'm like, superannuation itself is not the investment. Superannuation is the tax structure. You can invest in whatever you want within super, within reason, but you have full control over how you invest, the investments in it. Think of super just like the structure. And when you're thinking about the fund that you're with, so for example, Australian Super, Care Super, Australian Retirement Trust, they're the administrator of the fund. You're not actually invested in those companies like investing in CBA or whatever. They're the administrator. You're paying them to organise everything, do your statements, call them, all of that. But however you're invested, there's lots of underlying investments in there that you actually have a bit of control over what you're investing in. It's not particularly that actual company, which people don't realise.
Okay, so I'm going to ask why super is important. And this is from the context of, let's take this from the context of someone's just joined an employer. They filled out that pesky form.
Yes.
Don't really know what's happening. So take it from that perspective if you want, but also the person that's like, holy heck, I'm not going to be working soon. I got this thing called super. I need to get it in shape. Like, give us the kind of the nuts and bolts of why it's important.
Okay, so why it's important is it is literally your money. Work is slicing 11.5% of your pay. It's not a bonus. It's not money from the government. It is literally your money being sliced out of your pay and put somewhere on your behalf. So you've worked really hard for that money. You should care where it goes. Like if I knocked on your door and said, give me 11.5% of your pay, you'd be like, why? So that's exactly what you should be thinking when it goes to your super fund. Why? And we're all, it's very trendy now to have, to be investing and all of this stuff. If you've got a super fund, if you've been working, you're already an investor. This is, for people under 37, super will be likely be their biggest asset that they have. For people who are over 37, it's probably going to be second to a family home. But that's huge. So it is literally your money being sliced out of your pay. You need to care about it.
I didn't know that statistic.
Yeah, I've repeated it so many times, but I can't remember where it's from. But we can Google it after.
So people should know that Gemma's background, obviously financial advisor, but also money coach. you've spent so much time working in and around super.
Yes.
So it would make sense that you have these things on recall. So you mentioned, so it's your money, but you also talked about like the structure, and I think this is really important. So the difference is, if I'm not mistaken, I could put money in super, taxed slightly less on average, than if I just input it in a brokerage account like CommSec, Perla, Self-Wealth, Stake, one of those things. So I can almost make the same investments.
You could be doing the same thing. Like, so people think it's so different to what they're doing in their personal names. It's not. The only difference really, like to keep it really simple, the main difference is the tax. So it's taxed concessionally. It's not taxed at your marginal tax rate. And that's for the money that goes in there via contributions, but also the earnings. Whereas if you have that money outside, you'd pay tax on it first to get it from employment. And then any of the investment returns, the earnings that you had, they'd be added to your taxable income for the year, and you'd pay them based on your marginal tax rate. Whereas super, under this structure, is taxed at, for most of us, those earning under $250,000 a year, it's taxed at up to 15%.
Yeah, that's good.
And then if you earn over $250,000, it's taxed at 30%, which is still much lower than your marginal tax rate in that instance. So it is just a tax structure. So the benefit is tax. If you think of pros and cons, the con would be that you don't have, it's preserved. So you don't have control over when you can access it. And that's what people don't like about it, which I totally understand. But I also think that that's a great thing about it, because we need that discipline. And if you can work super with your other investments, you can actually build a really robust financial, like, retirement plan. So yes, you may not be able to touch super till you're 60 or 65, but you could have other assets that complement that. So if you are going to retire at 50, these assets work together. But it's a very tax effective way to invest for your retirement, and it doesn't have to be all or nothing. It can be part of other assets that build that flexibility that you potentially want.
I love the idea of super from our podcast perspective, because it is locked away for a certain period of time. The key thing is that you can make a very, very small change now, and due to the power of compounding and lower taxes, one tiny little change, like a little nudge in this direction, sends it off into the distance at someone once used an analogy of the Hubble telescope, which is this giant telescope up in space, and it's used to observe the universe, right?
Yep.
If you move that like 1 millimeter, like you move the dial like 1 millimeter, you're looking into a different galaxy.
Yeah.
And I think that's the kind of point, is that you move it just a little bit. You pick the right option, or you pick the right strategy, all of a sudden your retirement looks way different. Or you add a little bit extra now, just a little bit, not much.
That's exactly right. And that's why you need to care about it when you're younger, because those tiny changes make huge impacts. But generally, like in my experience as being a financial advisor, we generally see people start to want to learn about super and care about it 55 plus, when it's getting closer to retirement. And that, like, there's still so much you can do, but the amount that they have to contribute to do the same as if they had have just started and done small tweaks like 10, 15, 20 years before, it's drastically different. So, like, for example, you might start making contributions while you're younger, and then have to stop it because you now got your first home, or cash flow's different, or you've gone on maternity, parental leave. Those contributions that you did while you're able to are going to keep working for you that whole time, thanks to compound interest. So you can change your strategy, and it hasn't undone all of the hard work that you've already put in. So I think if you can do something do it while you can, even if you have to stop it. It doesn't mean, that you have to commit to that strategy forever, but that will still do amazing things for future you.
There's probably 3 big ways that everyone listening to this can grow wealthy. One is super. One is their property, and one is their investments outside, like shares and ETFs that they buy themselves in their own name or whatever. And this is what I mean, like low-hanging fruit. Everyone has to do this. Even if you don't have money right now to invest, or you're saving for a property and you feel like I shouldn't put that money into shares or ETFs, you can still make positive change with super.
Yes.
We are going to talk about insurance that can be held inside super later. So that will come later in the summer series. I will just sprinkle some ideas for people that may be in these situations, because this could change your life. If you have under $500,000, there are particular ways to get money into super that significantly advantage you tax effectively. Most people can make contributions to super and claim a tax deduction, which is awesome. It's basically the government saying, yeah, you can claim a tax deduction for something that is going to be good for you, rather than just going and buying a new car or something thinking it's a tax deduction, it's going to be good for you. There's things like spouse contributions. There are things like where if, say, a parent is going on maternity or paternity leave, the other partner who's still working can split some of the contributions from their employer.
Yes.
So if my wife goes on maternity leave, I'm still earning, say, $100,000. There's $11,500 going to my super. I can say, well, let's go halvies in that. And I just fill out the form. First home super saver scheme for people that are looking to buy. Just check the latest numbers because it has changed a little bit, but $50,000 that you can effectively contribute.
I think this is a really good point. So lots of us have trouble seeing the benefit of like super because it's so far away. But there are things that your super can be doing for you right now. It's not just a retirement benefit. So saving for your first home, paying for insurance premiums that are vital for you funding your lifestyle that you potentially can't pay out of your cash flow.
Yep.
And just learning about investing. Like if you want to be an investor and start investing and learning about shares and all of that kind of stuff, engage with your super fund. That is an investment portfolio and that can really help you learning and on that journey so that when you're ready to invest in your own name, you're already really understanding how that works.
Yeah. And I think if you're the type of person that's been a bit dormant on your super, I would highly encourage you to do just one thing in this episode, and I'm sure you might have some things to do for them to do as well, is just log into your super fund. Like go to the website, you'll have like an admin number that was like emailed to you or something. You might have to do lost password, but log in. It's often an app as well. And just see what investment strategy have I chosen or has been chosen for me.
Yep, the default one.
Which is more common.
Yep.
Am I in a growth strategy? If you're younger, it's probably what you want to be in. What is my insurance?
Yes.
I think that's a key point.
Yeah, so it's really common. I'll hear people say, my super fund is so expensive. So many fees are coming out. And when I look at it, some of it's contribution tax. So that tax when your employer puts money in, it's not actually a fee. That's got nothing to do with the actual fund. And other times it's the insurance as well. So they're not understanding that there's actually default insurance in there. So if you have insurance in there, you want to make sure that that's the cover that you need and it's right for you because you are paying for it and it's coming out of your retirement savings.
Yeah, that's one thing. Someone say, let's say, I don't know, round figures. Someone might say, I've got $100,000 in super, and they go, oh, I'm paying, I don't know, $500 in fees, $1,000 in fees, and then I've got $3,000 in insurance, hypothetically. They're like, oh, so it's $4,000 in fees. No, the insurance is separate. You don't have to have that if you don't want to, but I hold my insurance through super, and it's good to get advice on that.
Yeah, but it's important to, distinguish them. And you, like I always say, is like, and we'll talk about the insurance episode, but super's generally good at managing super. That doesn't mean that they're good at insurance. Yeah. And they've generally picked the one insurance provider that suits the majority of people, might not actually suit you. So you can pick a super fund based on it being great for your super needs, your investments, all of that type of stuff. And you could pick a different insurance company that's perfect for you, the best for you, and you put them together so that the insurance is paid by your super, but you don't just have to get what insurance is offered by your super fund. You do have choice. You get to choose your investments. You can choose your insurance. You can choose the administrator of your fund.
Yep. So someone's listening to this. They're like, okay, I've filled out that form. Got my insurance. I've logged in. I've checked it. Great. What things do you want people to listen to? You're the super expert around here, Gemma. There's no doubt about that. What should people do as a result of listening to this episode? Like, how can I make positive change right now?
Okay, so two things. One, if you have no idea where your super is, you should be going to your MyGov account and going to the ATO link and you will see your super details there. It updates once a year and it will say if there's lost super, if there's different funds. There's your super details, then get in contact with that company. So that's if you don't know what you're doing, like you don't know where things are. If you do, once a year you should be checking in with your super fund. So that is put a diary, like an event in your calendar and check in with your super fund at least once a year. You don't need to look, if you've already looked at your super fund and it's the right investment and it's the right fund, you don't need to be reviewing that every single year. What you want to be checking each year is your contact details are up to date. Contributions have been going in if you're working. Your insurance is still the right level. Just engaging with the actual fund. But yeah, just making sure that you're regularly checking in with it so that you're attaching it to value and that you're seeing that it's your money. And very importantly, if you get a letter from your super fund saying that they have underperformed or they're merging or something, do not ignore them. They're writing to you because there is an issue that you need to take action.
Tell us about that. So they've written to me and they've said, we've underperformed.
Yes.
Why do they do that?
So our policy came out a few years ago now. And yeah, so like the government makes super funds write to us if they need to tell us about their performance. And it used to be that they worded it a certain way or they would focus on different returns. And we never want to pick a super fund based on 1 year in isolation, right?
Sure.
Because it doesn't tell us enough.
Don't just choose the one from last year.
We want to look at long term. But if your super fund's contacting you because they've been made to for underperformance, or then like sometimes those letters are saying based on a series of underperformance, we're now no longer able to accept new members or contributions. This is important stuff that you need to know. So yeah, if you're getting a letter from you want to read it. It might just be that they're merging and sometimes that's a good thing. Sometimes it lowers fees. It might be they've added a new investment option which might actually be much better for you. Just read it. If you have any questions, contact your fund and talk to them. You're paying an administration fee for them to look after things so you can talk to them on the phone.
Yeah, and I should also say the big benefit for most people is that once your money is in super, sure, it's locked away and it's taxed in there, but once you hit retirement, you can draw tax-free income.
Yes.
That is the big magic super thing that makes it super.
Actually, so on that, I find also that people can't like wrap their head around super because they don't know what it is in that sense. So really simply, think of super right now as a big bucket. It's filling up. When you get to retirement, imagine just putting a tap on that and then you're drawing money out. So work money is stopped and you're now getting a pay every fortnight or monthly, whatever you need to live off. So right now it's just a bucket of money that you want to be as full as possible so that when you put that tap on it, that's actually what you live off. It's
what we call passive income.
It is, yes.
And you go from actively earning in your job to passively earning from your super fund. Exactly. A lot of people around this stage of life, and some of us listening might be in this camp, you get to that stage and you're like, this is pretty daunting. That's why you have super. That's why you've done it your whole life, right, Gem?
Exactly.
So key points. Check with your insurance, check with your super fund, check your insurance, check your investment strategy in there. If you don't even know what that is, go to the MyGov website. It's a government website. Link it to your ATO and find your lost super. I think it tracks via tax file number, right?
Yeah, so and the MyGov, like in that ATO section, you can see, like you were talking about the contributions, if you've got under 500, you can see all of those records in there as well. There's so much information on what's been happening with your super fund all recorded there.
Yeah, they give you, like if you can add extra, they track different things. Like it's actually really helpful nowadays. Yes. It's not what it used to be. The Money Smart website is great indeed. We do have a free super course. We'll include resources in the show notes. If you want good advice on not just super but everything, you can reach out to a financial advisor. Sometimes your super fund offers some sort of scheme as well. You don't have to go to a full service financial advisor, but that is the place to go. Key thing I just want to say before the end of this, do not change super funds unless you have considered your insurance needs.
Yes.
Do not listen to what anyone else says. Do not do that because it is... I've seen this happen the wrong way. If you've got a family, if you've got a mortgage, you have responsibilities, at least stop to consider the insurance guide before you switch. That would be my one parting piece of wisdom.
Lots of horror stories on people changing funds, not realising the impact it has on their insurance.
Yep. That's been great. A wonderful overview. Lots for people to think about. In the next episode, we're going to start talking more about their investments outside of super, being shares, ETFs in the next episode after that.
So, which that will also really help people understand super as well. It all links.
Yeah, so if you want to find out what your super fund's actually doing, one of the big things is they're buying shares. And so we will talk all about that in the next episode. If you do have any questions about your super fund, how to make a choice, what should you look for, write into us. There's a link in your podcast player in the YouTube description that says ask a question. Select the Australian Finance Podcast, and Gemma and I will be back soon in one big wonderful episode to answer your questions and to share feedback and wisdom from the community as well. So Gemma Mitchell, heaps of fun. Thanks again.
Thank you.
Thanks for listening to this episode of the podcast. Our summer series is brought to you by Betashares, the leading provider of ETFs here in Australia. In the next couple of minutes, I'm going to give you a rapid overview of one ETF, which is quite popular and often talked about inside the Rask community. Now, I'm going to refer down to my notes because the title of this ETF is a little bit complicated, but I'm going to debunk what it all means in just a sec. It's called the Betashares Wealth Builder Diversified All Growth Geared 30 to 40% LVR Complex ETF. Now, if you're like me and thinking, that's quite a mouthful, let's break it down. If you haven't already seen our short video on the Betashares Diversified All Growth ETF, we might rehash some of the material here because this ETF is quite similar to that ETF, except it adds a little bit of spice which you need to know about, which we call gearing. Firstly, it's from Betashares, a leading provider of ETFs here in Australia with over 1 million end investors being served by Betashares. Secondly, it says Wealth Builder in the title. That gives you a hint at what type of investor is probably going to use this style of ETF. Wealth Builder is probably for someone that's looking for growth over the long term. Diversified. As we covered in a previous video, diversified means whenever you see this in the headline of an ETF, it means that within that ETF, you'll find investments from multiple different investment types. So for example, inside this ETF, we will have some Australian shares, some United States shares, some other international shares, and some shares from emerging markets. Quite a few different investment types, all found in one ETF. We say that that is a diversified ETF. This ETF also uses gearing, and I'll come back to this in just a moment. Gearing is another word for saying leverage, which is another word that's similar to using a loan to buy shares. But hold on a second, because it's not using a loan specifically, you don't need to fill out any paperwork. Finally, it says complex in the title. And basically, this means that an ETF does more than just buy shares in an index or buy into some sort of sector that might be appealing, like the Hack ETF for cybersecurity. It does something that adds some extra layer of risk to it. So let's break it down. So we know that this ETF invests in all growth. It says that in the title. You get some Australian shares and some international shares. You get some from the United States, outside the United States, and emerging markets. And the portfolio itself is tilted towards more international shares because, again, it is targeting growth. You will find around 63% of the portfolio is invested overseas. And that's really important because overseas are where some of the world's most appealing growth companies can be found. And you'll find the remainder here in Australia. Invested in companies like Commonwealth Bank, ResMed, and these types of companies. So the gearing is what makes this ETF quite unique because it adds a little bit of leverage to the portfolio. And what it does is it magnifies the gains and the losses over time. Around 30 to 40% is what is added on top of the ratio that you put in. This is appealing to some investors because instead of having to fill out paperwork to get a loan to invest using your home as security, or maybe you don't have a home, so you look at other types of investments, this ETF adds the leverage inside of itself. So as investors put money into the ETF, Betashares arranges for an extra amount of debt to be used against that portfolio, which then multiplies the portfolio's returns and losses through time. Now, you can probably imagine that this does add a little bit of risk because you are using someone else's money and there's interest on that money that then goes into the stock portfolio. This is why this type of ETF has that complex name in the title, and why investors looking at it should probably have a high tolerance for risk and be looking to invest for the long term. If you're a bit confused or a bit unsure about this ETF, the two best things you can do is 1, read the GHHF ETF product disclosure statement and TMD, which is available on the Betashares website, and 2, speak to your financial advisor. Geared ETFs are not suited to everyone, but they do take away some of the complexity of using leverage to invest in a diversified portfolio. This ETF is quite unique and it's quite appealing to some investors. I would highly encourage you to go and check out the PDS and the TMD, both of which are available on the Betashares website for GHHF. And also, don't forget to speak to your financial advisor before making any decision to invest. Thanks for watching. Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.